Hi, I'm Malessa Rambarran.
And I'm Candice Milano.
Welcome back to The Build Up, presented by Brown Harris Stevens, where we discuss the secrets of building wealth through real estate.
Today we're joined by Jim Pfeifer, a former financial advisor turned full-time passive investor and the founder of Leftfield Investors. Jim shares how his dissatisfaction with traditional investment models led him to discover real estate syndications and how that shift changed everything for him. From becoming an accidental landlord in 2008 to now leading a thriving community of like-minded investors, Jim walks us through the key lessons, strategies, and systems that helped him create consistent income without being hands-on.
So today we're going to be discussing a topic that's, been ongoing, and that's why is housing inventory so low and what that means for the market.
Yeah, I think we've mentioned this in season one of this podcast, and there's a reason why it's continued to stay evergreen and a top of mind subject, although the answer is not just one simple answer. It's layered with many different reasons.
I mean, it makes sense, right? Let's break it down. A lot of homeowners are locked into really low interest rates. We're talking about 2.5 to 4%. Why would they want to sell when interest rates are so high in the 6s and 7s, right?
No, the golden handcuff effect is real, which is what you're describing. And so people that would have otherwise maybe upsized, downsized, relocated are reconsidering. And that's why we're not seeing many homes come on the market during this springtime and also just year round in general that we would have otherwise.
And then there's also the construction side of it, right? We've been seeing some developments in some cities, but nationwide, there's not a lot of homes being built. Years of underbuilding since the 2008 crash has created a real shortage of inventory.
Yeah, and even though the demand has stayed strong, there's a number of reasons why construction has not increased in volume and in speed. We have very high construction costs right now. We have labor shortages. There's also a lot of zoning red tape. So all of these factors combined have really slowed down the progress of new construction, especially affordable housing.
So what does this all mean? For buyers, competition remains tight. Especially for move-in ready homes. A lot of people, they want to, have turnkey. They don't want to come in and have to do all the work. But more so, especially like you mentioned, construction costs is so high. So it doesn't really make sense. That's why we always say be clear on your non-negotiables, but also you have to have some sort of wiggle room as well.
Yeah. And if you're a seller, now's your time to shine, right? There's a lot less competition in the market. And so now you can really try to maximize the value of your property, but also don't be greedy. Sometimes you can get a little too aggressive with your pricing, and people are very price sensitive right now because interest rates are high. So maximize your value, but don't go too far because you'll find yourself in a position where you won't be able to sell because it's just going to be out of reach. And also buyers are still looking for quality. So, do your best to prepare your home well for the market like you normally would, stage it, do all the preparation needed to really put it in its best showing condition. Because again, buyers are still savvy. They want quality and they want something that, they can actually afford.
And also for investors, this is a really good time because low inventory means that there's a really high demand, especially for rentals, right? So if you can scoop up the right property or add value, now is really your time as well.
And then lastly, if you're a builder, think about where there's gaps in inventory. So think, multifamily, affordable housing, workforce housing. All of these are key sectors that are really lacking in inventory. So try to focus there where you can hopefully maximize on the demand the most.
The bottom line here is unless rates drop significantly or we're seeing a lot more new builds, tight inventory is here to stay.
Yeah, and we're right. We're not going to necessarily see a big change, but what we should all do is adjust our lens based on what perspective we're coming from, whether you're a buyer, seller, investor, builder, really refine your approach, your strategy, and try to maximize the opportunity amidst this very tight market.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. We work with Brown Harris Stevens and many other top real estate firms, staging their homes to sell quickly and at the highest price possible. Our staging is affordable without sacrificing quality or design. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
When we first started Excel Real Property Management 11 years ago, we did so with the intention of protecting the investment community. Here at Excel Real Property Management, we focus specifically on serving the needs of individual apartments, townhouse, and small multifamily building owners both in Manhattan and select neighborhoods of Brooklyn. Our services encompass everything: rent collection, expense payment, handling maintenance and repair, turnover between tenants, insurance needs. Literally anything that an investor would typically handle him or herself, we take care of for them. Whether you hold one individual apartment or a rental building that houses 20 units, Excel is here to help with all of your specific needs.
So today we're joined by Jim Pfeifer, founder of Leftfield Investors, a thriving community of passive investors. A former financial advisor who became disillusioned with traditional investing models, Jim pivoted towards real estate syndications and has since helped educate hundreds on the power of passive investing. In this episode, we'll unpack his journey, the founding of Leftfield Investors, and practical tips for building wealth through the community and collaboration he's built. Jim, welcome to the Build Up.
Thank you. Thanks for having me. I'm excited to be here.
Same as us. We're very excited to have you here today and to talk real estate. But you began your career as a financial advisor, a path many associate with traditional investment wisdom. So what led you to question that and start thinking about real estate?
Yeah, so I'm kind of on career number 6, and financial advising was kind of in the middle. And I was a finance major in college. I've always been interested in finance. And as soon as I got my first job, I think the first question I asked my employer is, when can I put money into my 401k? Because I was confident the way to build wealth was by investing in stocks and mutual funds and things like that. And so I did that for the first 15 years of my career. I went through the dot-com bust. I went through 2008. And about that time, when I was starting my journey to become a financial advisor, what they do is they just start over and pretend you know nothing about money or finance, and they just train you from scratch. And so as they were teaching me about money, at the same time, I'd become a landlord, accidental landlord. That's the word I'm looking for, because we had built a new house. It was 2008. We couldn't sell our old house, so we rented it. And I absolutely hated it. I hated being a landlord. I hated everything about it. But as I was learning or relearning finance, all the things that the people were teaching me, my employer was teaching me, I was seeing real estate and what it did to my finances. I loved the financial part. I just didn't like being a manager. And so they were teaching me, here's how money works and all of these, clever ideas. And it was pushing me more towards real estate because I realized it applied a lot better to real assets that I was looking at through real estate than it did to the paper assets that they were pushing us. And so what I realized was that Wall Street investments, the stock market, mutual funds, that's speculation, right? You buy a piece of paper, an electronic piece of paper, and it has no current benefit, and you hold it, and then later you're going to sell it, hopefully to somebody else for more money. That is speculation, right? And what I was learning was real estate is where you buy an asset and you have a current benefit in the form of cash flow. And then on the back end, when you sell it, hopefully you have appreciation. But even if you don't, you've still made money in the hold because you have cash flow. And cash flow is what I was looking for. And so that made me realize that the financial advising world and paper assets isn't where I wanted to be. I always prided myself in investing in the same things that my clients were. So I had a short financial advising career. It lasted about 7 years because the more I got into it, the more I was getting into real estate, and I couldn't get my clients into real estate because I wasn't licensed for it. And, I wasn't compensated for it. And that's why financial advisors don't really put you into real estate, in my opinion.
Yeah, that makes sense because, again, like you said, it's not an asset class that they're as familiar with and definitely aren't being financially compensated for. So why would they push you in that direction? I mean, obviously they're there to advise you, but also they're there to earn a living. So it's important that, people understand that when it comes to financial advisors, that they may be missing out on a complete asset class that could make a lot of sense for them, like you discovered, through your own career. Were there ways in which your background as a financial advisor helped you as you got started in real estate, or maybe even hindered you? How did that transition work for you?
It definitely helped because once it's alternatives, right? That's what they call it, but it's not alternative. It's the place you live. It's the place you go work. It's the place you go shop. Everything is real estate. So it's shocking that as a financial advisor, the only access to real estate you have, unless you're doing family office type stuff, and that's a whole different situation, is probably a REIT, right? And so being a financial advisor, it showed me there are some really good type investments in that world, the paper asset world. There's some that I still like, but the real estate was showing me how I could find those investments that would kind of help out with my real estate or be a turbo boost to my real estate. And so as I was learning to be a financial advisor and learning more about real estate at the same time, the advantage I had was I was able to kind of pick and choose the investments that made sense, or the structures or strategies that made sense in the Wall Street world, and combine that with what I was doing in real estate. And it really just, as I said, turbocharges or just really enhances the real estate investments I had. So where I am now is the strategies and everything I do in the paper asset world is in support of what I'm doing in the real estate world. So I really object to the term alternatives, right? Because people say, oh, just put 5 to 10% of your wealth in alternatives. And I could not disagree with that more. And I did swing the pendulum too far and got completely out of some of the Wall Street stuff, and then realized, okay, there is a place for that, but that's a smaller allocation than my real estate.
Exactly. And I like that you're able to, use your knowledge from Wall Street and apply that to real estate. That's super important. It puts you ahead for sure. But I want to touch on this tribe that you've created for passive investment, right? So you formed Leftfield Investors, and it's more than just an investment group, right? It's a learning community. So talk to us about what inspired you.
Yeah. So the part of the journey was I was an active real estate investor, right? I started with that accident, being an accidental landlord. And then I realized, oh, wow, this is kind of cool. I like I don't like managing this, but I like the real estate. So I hired a property manager and started buying other single family properties around Columbus, Ohio, where I live. And then I started buying turnkey investments, or turnkey single family. And then I started buying multifamily. And I realized pretty quickly that I wasn't very good at being an asset manager. And so I wanted to transition to something else. But while I was doing all this active stuff, I started a meetup of active investors because I wanted to learn and find people that I like to do business with. And so that was how, when I then found out what passive investing was and syndications were, I thought, wow, this community really helped me before. So I'm going to do the same thing for passive investing, but I wanted to make it a mastermind. I wanted to make it just 10 to 12 people, just small, because not many people understand or know about this. So I didn't think I'd get a big group. And so we were going to be a dinner club, and we were going to meet once a month. And our first meeting was supposed to be March 18th, 2020. And if you, remember what time that was about the time the world shut down. And so we couldn't meet in person. So we met online. And that was what spurred the growth of Leftfield Investors, because now we could go online. We're using this new fancy tool called Zoom, and everyone was stuck at home. So we were able to get some really quality, good guests because they had nothing else to do. So they'd come on a Zoom call and talk to 20 people in Ohio. And slowly it grew. Former financial advising clients and colleagues got interested, and other people got interested. We spent the first year trying to restrict the number of people because we were thinking mastermind. And then the demand was crazy. More and more people were asking to join. And so that's when we started our website, and we started the community Leftfield Investors. And we grew the community for about 4 years. And then we realized that the resources we had, because we were basically working as volunteers, it was a passion project. We never thought it would be a business. We never thought it would make money. And so we really didn't put all the pieces in place to make it a business that could sustain itself. So actually last fall of 2024, we partnered up with Bigger Pockets, and now Leftfield Investors is Passive Pockets, and we merged with them, and it's the same community, but now we have the resources from Bigger Pockets, which is a community of 3 million people. So we have their resources and their expertise combined with what we know from Leftfield Investors about passive investing and syndications and that type of community. So now we kind of have the best of both worlds.
Certainly. I mean, that's a pretty big platform, bigger pockets. And so that's an amazing thing that you were able to merge with them. And it's clear that there is a lot of people who are hungry for this type of information about real estate investing overall, but specifically passive, because a lot of people obviously have other careers, other responsibilities. And as we know, active investing can be a full-time job in itself. So the passive side is very appealing to people looking to diversify or to just grow their wealth. And so it's not a surprise that your community grew so quickly, as well as it made sense to merge with bigger pockets. And so can you share a little bit about what types of resources and support system you offer your members and community so that they can go from curiosity to confidence?
Yeah, that's a great question, because it took me a long time kind of to figure this out. But, we talked about alternatives. And so everyone know, you walk out your front door and you talk to your neighbors about your personal finance, right? They're going to mention their 401k, an IRA, the interest rate on their mortgage. And then you're going to come in and say, what about alternatives? I invest in syndications. And you're going to turn around and everyone's going to be gone because no one wants to talk to the weirdo, right? So it's really hard to do this type of investing. A lot of the investments are hidden, right? They can't be advertised. So you have to know this world. These are long-term investments, completely out of your control, right? Because once you send the wire, that's it. Then you're just, accumulating reports and hopefully, cash flow. So a community makes all the difference, because you can invest. Let's say you want to test out an operator, right? So you send them $50,000 for one investment. Well, that investment is likely going to go 5 to 7 years before it goes full cycle and before you really know, did it work or not? Well, if you're an investor like we are allocating capital, you can't wait 7 years before you make your second investment. So how do you figure out who are the good operators? Because there's good operators and there's bad operators. When I did it, I was a bad operator, but I made money because the market went up. Well, we're not in that situation anymore. So you really have to pick your operators. Well, how do you do that? Right? There's a lot of different ways, but the way I've found to do it is I don't invest with a new operator unless they're introduced to me by someone I know, like, and trust, who's in my community, who's already invested with them. It doesn't mean they've had to go full cycle, but maybe they've invested with them for a year or so. And they know, yes, reports come like the operator said they would. And most importantly, the wire when you send it, which, sending wires, let's face it, is terrifying. It's going to get to the place that you're sending it, right? And you also know, or distribution is going to come or not. You have some information. So you still do all the same due diligence on the operator, but having a community and a reference and a referral, you're starting from 100 steps ahead. And so that's the value of the community, right? But there's a lot more in the community that we do. We have a forum. So you can post, hey, has anybody heard of ABC operator? And you'll get people saying, yeah, I've invested with them. Here's what they're like. We have a red flag forum where you can post any operators that, you're dissatisfied with, or things didn't go well. You can post so other people can look out for it. We have operator reviews. It's like a Yelp for syndicators. So you can go on there and rate somebody 3, 4, 5 stars, and you can read other people's ratings. We do deal reviews where we have operators come onto our platform, pitch a deal, and we have a panel of 3 experienced LPs who ask the tough questions. And with that, we're not trying to play gotcha with the operator, right? We're just trying to show LPs that you can ask the tough questions. You can ask the uncomfortable questions. If an operator isn't willing to ask those questions, then they shouldn't be accepting your money, right? So we try to ask the tough questions. And at the end, we ask the operator, we say goodbye to the operator, and the 3 panelists discuss the deal. We talk about the red flags, additional questions we might have, the good, the bad, the ugly. And really, it's just showing LPs, here's how experienced people do it so you can learn. So our community is all about learning and sharing and just helping people become better LPs.
So I do have a 2-part question. First of all, we have a lot of new investors listening to this podcast. And why don't you explain to us what exactly is real estate syndication and how do you diverse in passive investing?
Yeah, I love this question because when I started in investing, I thought I was a passive investor because I hired property managers, but that was active investing, right? I was constantly arguing with the property manager about evictions. I had to go get loans and deal with loan officers. I had to buy the property and do all of that stuff, right? That is active investing, but I thought it was passive. And so then I found what I call passive investing, which is what I think true passive investing, where all the work I do is up front. I invest in something called a syndication. Basically, that's just a group of investors that come together to buy something. So a good example is, let's say there's a $20 million apartment building. And let's say you can get a loan for 75%. So you get a loan for $15 million. Well, most of us don't have $5 million in our pocket that we're able to put down as equity, right, as the down payment. So we might go to a group of friends, family, or other investors and say, hey, let's all contribute together and syndicate this deal. So it's a group of what we call limited partners. They're LPs. Those are the people that are passive. All we do is contribute capital and questions, right? Because we're going to ask a lot of questions of the operator. And then the GP is the general partner. That's the operator. That's the person who is doing all the work. They're active. They are buying the property. They're getting the loan. They're hiring the property manager. They manage the asset, and they're the general partner. And so they have, we're basically in business together, right? Because there's an LLC that is formed to buy this property. We are business partners. I'm the silent partner. I get benefits, and that is hopefully cash flow and hopefully the upside of appreciation. And the general partner gets benefits because they also share in those returns, but they also get capital, which is needed to buy those products or projects. So that's what a syndication is. And then the diversification is it might be one of the biggest benefits of syndication investing, because we want to be real estate investors, right? Well, when I was in active real estate, thinking I was passive, but I was definitely active, I bought single family homes in Columbus, Ohio, multifamily homes in Columbus, Ohio, and single family homes in Memphis and Indianapolis. So my diversification, I was in, maybe you call it two asset classes, single family, multifamily, but they're really pretty much the same. And I was in 3 markets. And I had one operator, which was myself. So if I was a bad operator, I compromised all of my investments. If Columbus, Ohio was a bad market, I wasn't much diversified out of there. If single family homes or multifamily homes weren't good asset classes, I had very little diversification. Now I diversify in multiple ways, different operators. So I have a lot of different operators who might invest in the same asset classes. I invest in multiple asset classes. There's self-storage, mobile home parks, RV parks, car washes, multifamily. I mean, there is just a ton. There's triple net lease, industrial, commercial. You can go on and on. Motels, almost anything you can think of can be syndicated and made into if real estate wise can be made into an asset class. So I diversify by all of those asset classes. And then markets, right? I am invested in Dallas, Atlanta, Salt Lake City, Las Vegas, Columbus, all over the place. So now I have diversification by a lot of different things. So instead of having, when I bought a 22 unit, I think I had to put, $500,000 down, right, in one asset. Now, if I invest $500,000, it's probably in a minimum of 10 different projects. And those will be in different asset classes, different markets, different debt structures, different operators. So I think diversification is really what sets this type of investing apart. And you can't do it if you're active, because you can't be an expert in that many things in that many markets. Just not possible.
It's certainly not. And it's great that you were able to really grow your portfolio. But as we all know, when it comes to scaling anything, it requires really good systems and tools and platforms in place to manage everything. So what works for you? What processes do you use to evaluate deals as well as manage the ones that you end up investing in? And again, we know you're passive, but you still have to have a way of evaluating and tracking all of these different deals that you're invested in.
Yeah, that's a great point, because one of the biggest challenges is tracking all of these investments. So I'll start with that. I tried for a while. I had Excel spreadsheets, right? And you're getting all these distributions in, and you have, I have 50, probably 100 different investments, and it's a lot to manage. And you get some cash flows come in monthly, some quarterly, some annually. It's just crazy. And so I had spreadsheets that were fighting with each other, and it was a chore. There was times when I was like, I'm not investing in any new deals because I can't manage it. So then at Leftfield Investors, we said, we're going to come up with something for our community. And we hired a software developer, and we tried, and it was terrible, and we couldn't figure it out. And then we met this company, Visor, and they have it figured out. They have the first wealth management platform I've seen that allows you to easily track your syndications. And the nice thing about Visor is you can track it's basically a normal financial tracker where you can put in, link in with your Schwab account or whatever. But the great thing is it is optimized for syndication investments. So now when I do a new investment, I just enter a few clicks in Visor and it's entered. And then anytime a distribution comes in, it gets automatically, or you can do it automatically, but I'm a little bit, too much of a control freak. I like to put my own stuff in. So I just enter it in. But, that was a game changer because like you said, I have 100 investments, right? That means I have 100 K1s. So tracking those is a challenge. I get, it's very easy to lose track of stuff. So getting a management tool there is critical. And so that's where I found I use Visor. And then as far as how to, the work you do before the investment was the other question. And that is probably 80% of the work goes the way I look at it is going into the operator, vetting the operator. We talked a little bit about that. And then the other maybe 20% is evaluating the market that the deal is in and then evaluating the deal. And for me, there's a lot of work that goes into underwriting a real estate deal. Well, I'm a passive investor, so I'm not going to underwrite it like I'm going to buy it myself. There are some passive investors who do that. That's not how I do things because that's not my strength. What I want to do is I evaluate the operator. And then when they send in a deal, I will test them. I'll ask them a bunch of questions, but I'm trusting them to have done the underwriting. And then I will just make sure, hey, does this make sense? I'll check the financials. I'll check the pro forma. And I just won't dive into it as deeply as they do. That's their job. My job is just to make sure that they are doing their job. So that's kind of how I look at it.
Mm-hmm. That's great advice. I do have a follow-up question to that. I think just, people listening in right now, they might not just have any idea on real estate, right? And the whole idea is to be passive. So what would you say are some things that they should at least look like the basic that they should be looking out for? Yeah, well, the first thing is I would say is educate yourself a little bit and join a community. I think that's the most important thing. It doesn't have to be Passive Pockets, where Leftfield Investors is now. There's a lot of other communities. You find a community that fits your personality, right? So that I think is number one. Number two, when you're looking at a real estate deal, there's some things that translate from deal to deal to deal. And some of the things I look at are just realistic assumptions, right? Right now, rent growth is pretty stagnant in most markets. So if someone says, hey, I'm going to get 10% rent growth, okay, that's a red flag, right? Or let's say they say 5%, but they say 5% in year one. Okay, well, when you buy an apartment complex, all the rents don't renew the day you buy it. So if you are going to raise them 5% in year one, that's probably going to have to be, you're raising them probably 10 or 15% to get to that average 5%. So things like that. I look at the taxes, right? I want to make sure that usually when a property sells, depending on the state and the county, the taxes go up because the assessor reassesses it. So if your pro forma year one taxes are the same as the T12, which is the current year's taxes, that's a red flag. I feel like it should be an increase. And then I look at things like vacancy. Do you have realistic vacancy assumptions? When I was an active investor, I just put everything at 5%. Well, now that I know a little bit more, I know that's probably understated depending on the market and everything. So I look for realistic assumptions. That's the main thing. Like I said, I'm not going to dig in and re-underwrite everything. That's not my expertise, but I just look for anomalies. Is anything weird? And then what I do is I make sure to ask a lot of questions. And there's two reasons I do this. One, because I want to know the answers, but probably the most important part of asking those questions is before I send somebody my money, I want to see, are they going to communicate with me? Because if they're not going to communicate with me before I send the wire, what makes me think they're going to communicate with me afterwards? And as I said, these are illiquid investments completely out of your control. The only thing you have is the relationship with that operator and the ability to call that person or email that person and say, hey, what's going on with my investment? That's the advantages of syndications. If you buy shares of Apple, you can't get on the phone with Tim Cook, or I can't at least, and ask him how things are going, right? But in the syndication, that's part of the benefit. You can. So I test them and I send them a bunch of questions and then they answer them. And then even if I don't have more questions, I'll send them another email with additional questions because I want to make sure, hey, are they going to go the extra mile? Are they going to put up with someone who's maybe a little bit more high maintenance? And you know what? If I'm too much for them, I'm moving on because I think the biggest
things you want in this as being this type of investor is patience, right? There are always new deals. There are always new operators, but you're going to get emails with best deal ever and lights flashing and a lot of pressure that invest in this because it's one of a kind. A month from now, that same operator will send you a very similar deal. So you don't have to panic. Have some patience and really do your analysis.
Yeah, thank you. That's really, really helpful. Just some of the, immediate things that people should start to think about when they are vetting an operator. But let's go into, you've had now quite a long experience and career as a real estate investor. So what have been some of your biggest wins, or if you want to share any failures, both as an investor and a community builder, that have taught you some valuable lessons?
Yeah, I honestly, I don't think you learn a whole lot from your wins. I've had some. A big win was a partnership with Bigger Pockets. That was fantastic, and it still is fantastic. But really, where you learn is from the challenges and from your losses. And so, I think some of the big ones for me was I don't want to be anyone's guinea pig, right? As an investor. So the example I use is there was this operator who I really liked, and they did turnkey rentals in Dallas, and they did a really good job at that. But Dallas, the market got to a point where those weren't working anymore. Just the metrics didn't work. They weren't cash flowing. And so that operator decided they were going to do small office, like local, strip mall offices. And I thought, well, they were great at single family homes. So of course they're going to be great at this other thing. And I hadn't been investing with them for a full year. But I also recommended this to my parents and my sister. And so we all invested with this operator, and they were a disaster because they didn't know what they were doing. So what I now is a couple of things. One, I don't invest with the same operator in a second deal until at least a year has passed. So I can see, are things going the way they say they're going to go? And if not, do they communicate why not? But more importantly, I'm not going to be your guinea pig. I'm not going to, while you're learning something new, I'm not going to give you my money. So you see a lot of large multifamily operators are getting into other asset classes. Usually first they go to self-storage. Well, I'm not going to be in your first self-storage deal. And I'm going to look and see, okay, how are you doing this differently? So did you hire someone with self-storage expertise? Okay, well, that helps, but I'm still going to watch and wait for your first fund or your first few deals to see how things go. So I think that's really one of the major things I've learned. And then the other one I already said is patience. And, I have a podcast as well. And one of the guests on one time said that his favorite thing is JOMO, right? We're all familiar with FOMO, and that's how, fear of missing out. Well, JOMO is the joy of missing out. And I've stolen this from him, but it just means like when I see a deal and I feel pressure because it's a operator that says, hey, this deal's going fast, you got to jump in. I'm just going to sit back and have patience and have the joy of missing out on this deal, knowing that the next one's coming. And so I think those are some of the things that I've really learned. And I'm not, I'm the guy who chases the shiny object. When there's a new asset class, I'm like, oh, marinas, right? That's great. Let's jump in. And I really have to slow myself down and have patience and realize, it's okay to be excited about these things. But if I'm going to speculate on a new asset class or something really risky, I'm going to do that with a very small part of my portfolio. Everything else, I'm going to invest in boring. I don't want anything exciting. I don't want people to be like, oh, hey, what's this cool investment? I'm like, nope, I'm just making 8-10%. And, a side note, one of the other things I've learned is the biggest eroder of your wealth is taxes, right? And what's the best investment to reduce, eliminate, and defer tax? It's real estate. Hands down. And so I think those are the things that I've learned over the years.
Yeah, well said and well put. I mean, like you said, you do learn more from your mistakes, from your failures, than you do from your wins. So thank you for, being open to sharing that with us and with our audience. And so one final question, which is that, you've been on both sides. You've been a more traditional financial advisor, dealt more with the, stocks and bonds and all of that. And obviously you've been on the real estate investment side. So as someone who's seen both sides, what would you say to people who might be on the fence, especially those who are afraid to take that first leap into real estate syndications?
I would say first, look around at all the rich people, wealthy people that you know or that you know about. And I challenge you to find any of them who built their wealth earning money as a W-2 employee, right? Or investing in the stock market. There's two ways to build wealth in America, right? And it's buying businesses, which is what people like Warren Buffett do, right? He did okay. And real estate investors. And a lot of it's because of both of those types of businesses have significant tax breaks and cash flow that come with them. And so what I would say to somebody who's on the fence is get off the fence, educate yourself, and realize that if you want to build wealth, you're going to have to get out of your comfort zone and do something like real estate or businesses. If you're happy being who everybody else is and being just like everybody else, which is fine. There's a lot of happy, successful people. It's the easy way, but you're not going to, if your goal is to build wealth for your family, become financially free, have time freedom, have place freedom, you can't do that in a W-2 and you can't do that in the stock market. So if you know those that you can't do it there, where are you going to do it? And real estate, specifically for people who don't have all the skills to buy their own real estate, passive investing in real estate syndications is the way to do it, in my opinion.
Wow. Yeah. I mean, I think you found your calling in general with just being an advisor, whether it was for traditional stocks or real estate. I mean, you make a very compelling argument, obviously one that we agree strongly with, but it's always great to hear it from someone else. Someone else has actually really gone through that transition personally. So thank you so much for joining us today and sharing all of your insights. We really appreciate it.
Thanks for having me on. It was a pleasure.
Hey, it's Stephen Bailey from Roadway Moving and Storage. As an official moving partner of Brown Harris Stevens, we know that your clients deserve more than just a move. At Roadway Moving and Storage, we turn moving into an experience they will love. From specialized services to a white glove treatment, we've got it all covered. When you choose Roadway, you're choosing a peace of mind for your clients. Plus, our referral program is the most rewarding in the industry. Want to learn more? Shoot me an email at steven@roadwaymoving.com or visit roadwaymoving.com.
Do you have a big move coming up? I'm Scott Nadler with Cross Country Mortgage, and I've got the loan to match your dream home. Whether it's your first or your fifth, I'll make the process quick and easy. Call me today. Let's make it happen.
Today's conversation with Jim Pfeifer was packed with valuable insights on the power of passive investing and the importance of community in navigating syndications, and lastly, how redefining traditional financial wisdom can lead to greater freedom and control.
Thanks for tuning in to today's episode with Jim. Be sure to subscribe for more inspiring stories and expert advice on real estate investing. And if you found today's conversation helpful, leave us a review and share it with someone who's ready to start building wealth the smart way.
This podcast is for informational purposes only and does not constitute tax, legal, or investment advice.
For specific recommendations, please consult with your financial, legal, or tax professional.
Always leaves your text on red. Leaves your text on red.
Built the courtroom group with $1,000 loan.
Tell us a little bit about how you actually came from.
Welcome to The Build Up, John Rowan.
Thanks for having me.
We're coming to you here from Studio 1873.
It's not 57% over $2.7 million.
So then, cheers.